Hello and welcome. My name is Anne Vroom. I'm a McGill alumna and I'm the university's Legacy Giving Ambassador. I'm very pleased to introduce this webinar, Securing Your Legacy, Estate Planning in Canada. Estate planning is an important exercise, yet it's one that we often put off, thinking that it will be difficult or unsettling. I certainly know that I felt that way when I looked at the prospect of doing my estate. Yet, once we begin the process, it is comforting and gives you some sense of control. Planning your estate ensures that you and your loved ones will be well looked after, not only during your lifetime, but beyond. It also provides you the opportunity to make your mark. Leaving a legacy gift allows you the opportunity to make long-term impact without affecting your current finances. Leaving a legacy is top of mind at McGill these days. This year marks the 200th anniversary of the university, which was founded with a generous legacy gift. To celebrate its bicentennial, the university has launched the 200 for 200 Legacy Challenge, and we hope to secure 200 legacy gifts during this year to celebrate our anniversary. As part of our giving to the university, my husband and I have left legacy gifts in our wills. Perhaps this seminar will inspire those of you who are attending to do the same. Legacy gifts not only support institutions like McGill, but they also offer tax advantages for the donor. I know that our very knowledgeable speakers today will be exploring strategies such as these in more detail today. So, without further ado, I would like to introduce our moderator and our guest speakers. Handling today's questions and the discussion are Professor Julia Scott. Professor Scott, wearing her red jacket, is a senior faculty lecturer in accounting at McGill's Desautels Faculty of Management. She has over 30 years experience of teaching at the university level and is an active member of the Chartered Financial Analyst Institute. Prior to teaching at the university, Julia worked at the TD Bank and at Ernst & Young. Philip Lieberman is a graduate of McGill's Faculty of Law and is a partner and registered portfolio manager at KJ Harrison Investors. Philip has 30 years experience working in investment finance and capital markets. Before joining KJ Harrison Investors, he worked at Scotia Capital, and prior to that, he practiced corporate, securities, and mergers and acquisitions law. Patricia Saputo is a McGill alumna with a graduate diploma in public accounting and taxation. She's a certified wealth transition coach, a financial coach, and is the chief financial officer of Placement Italcan Inc., a diversified investment holding company. Her areas of expertise include personal and corporate taxation, investment planning, and estate planning. If you have any questions during this webinar that you'd like to address to our speakers, please submit them to the chat box. We'll do our very best to answer as many of the questions as possible during this session. So, without further ado, I welcome you all once again, and I'm going to pass the presentation over to Professor Scott.
Thank you, Anne. Thank you for that introduction, and welcome everyone to this webinar on Securing Your Legacy in Canada. We have with us today people from all across Canada. In case you're not from the Montreal area, I'll tell you that in the last 10 days, we've had a lot of snow. And I happened to be downtown a couple of days ago walking across campus. It's beautiful because the campus is empty. There's hardly anybody on it. The sun's shining today. It's a beautiful winter day, though perhaps your memories of winter on campus are not sunny, snowy days, but perhaps a lot of hard work. So today I'd like to thank Patricia and Philip for coming and spending time, taking time out of their busy schedule to be with us today. I'm looking forward to hearing what they have to tell us and you about estate planning in Canada. But before we delve into the estate planning issue, I wanted to look first at a more immediate issue. It's February. You've probably seen ads or pieces in the paper about RSP season and RSP deadline. So I'm going to ask Philip to explain the difference for you between an RSP and a TFSA and which of those you should be doing now and perhaps why. So Philip, can you give us a little insight on that?
Sure. Well, first of all, thank you, Julia, and thank you, Patricia. Delighted to be at a McGill event. I think it's my 30th anniversary from the graduation from McGill Law School this year. So I'm on the hook to give money as well to the faculty and to the school. So I'll talk a little bit more about our family's gift a little bit later on, but I'm delighted to be here with you. Look, I think these questions that we're going to talk about today, I think Patricia would agree, we're going to stay at a fairly high level because there's a lot of people today listening, which is great. But as you know, when it comes to financial planning, estate planning, and even the month of February, which is really, RRSP contribution season, it really comes down to each individual's tax situation and position. I'd say from sort of a 35,000 foot level at RRSP season, a normal question is, do I contribute to an RRSP or do I contribute to a tax-free savings account? The normal answer that you'd expect to hear from a portfolio manager that loves managing your money is that you should contribute to both. That is sometimes, possible in the case, and sometimes it's not. I'd say that with RRSPs, of course, you need to make sure and check with either your last tax return, with CRA, or with your active accountant that you've got contribution room and that you're actually able to make a contribution properly under your RRSP. I'd obviously say that, RRSPs we don't have a lot of tax shelters in Canada. So RRSPs are an excellent tax shelter, a tax deferral program that allow you to compound your investments over time till you need to start pulling them out of the RRSP, at which time tax comes into play. But some people have often said to me, well, I don't want to contribute to an RRSP, you got to pay all this tax down the road. But they forget that you've been compounding, hopefully, your tax deferred RRSP investment portfolio for 10, 15, 30, 40 years, depending on when you started. So you should try and contribute if you've got the contribution room. TFSAs this year, it's a $6,000 limit. The program started in 2009. You have to be 18 years or older to contribute to a tax-free savings account. But if you were 18 in 2009 to today, your cumulative giving or ability to contribute is $75,500. So that is, even though it came in 09, it is a very useful long-term savings account or investment program that you can invest in anything inside your TFSA, stocks, bonds, high interest savings accounts. It runs the gamut. You've got lots of flexibility. And then the only other question that comes into play is, if I can only do one, which do I do? And that very much, and I'll leave it to Patricia, comes down to kind of where your tax bracket is. Patricia?
So I'll jump in. So basically the difference with an RSP and a TFSA is, do you need the tax deduction in the current year? So with an RRSP, you get that deduction in the year you make the contribution, or if you make your contribution by March 1st, 2021, you can get the deduction for your 2020 tax return. Whereas a TFSA, there is no deduction. So what does that do is, in an RRSP, when you eventually do take the money out, you'll get taxed on it when you take the money out at your tax bracket at that time. Whereas the TFSA, if ever you do take that money out of your TFSA account, it won't get taxed in the future. So do you need the deduction now or not will also determine whether you should put it into your RRSP or not. Having a deduction can reduce your tax bracket, and sometimes you also want to look at optimizing your taxes, because even if you make an RRSP contribution and that money accumulates tax-free, maybe you want to use some of that deduction in the future years if your tax bracket has come down to a lower amount and you're expecting more income in the future years based on your investment returns, your salary, if you're going to get a severance package, depending at what stage you're at your employer's employment, or you're expecting, to have a large capital gain because you're selling a property or investments that have done very well over the years. So there's a lot of things to consider, and why I agree with Philip, it's very particular to an individual. So there's a lot of things to consider, and tax advice is recommended.
So both these funds make up part of your estate, right? So what happens to them if you still have funds in them, as this is an estate planning event, when it comes to settle your estate? Philip, can you answer that?
Sure, well, I'll start. So the first thing is in registered plans, which are TFSAs, RRSPs, as I'm sure many, if not all of you watching today know, that at some point in your 71st year, you must convert an RRSP into a RIF. And that's a tax-free rollover from an RRSP to a RIF. And TFSAs are all registered plans. And in those plans, you set out who your beneficiaries are. So the good news generally is because you've set out beneficiaries at your death, the plan, the registered plan, be it a TFSA, an RRSP or RIF, will roll over tax-free to the beneficiaries.
Great, thank you. So I think that covers some of the short term. We wanted to make sure you didn't miss that opportunity in February, but we're really here to talk about long-term planning and your estate planning. So before we delve into some of the questions we have, I'm going to ask each of Patricia and then Philip to give us a kind of a 1-minute overview. Patricia, if somebody walked into your office and said, I wanted to talk to you about estate planning, what would that encompass? What kind of things would you talk about with that client?
Well, first of all, I'd like to tell people that if you fail to plan, you'll plan to fail. And that's why it's very important to have an estate plan, because at the end of the day, you might no longer be around, but your loved ones and your family will be. And the last thing you want is to leave them with a mess. So that when you start talking about estate planning, it's more than just your assets and potential liability, but it's about having conversation with your family members. And it's not about talking to your professionals, well, what do other people that have the wealth I have do with, in their estate plan, and what do they do in their wills? It's really custom making it to what your needs and wants are, and making it very particular to your situation that might not be like the other clients that your professional advisors have. So if you don't sit back and think about what it is you would like for your money and assets to do for your beneficiaries, it's hard for an independent professional to think about that for you. So it does take time to sit back and think through the different aspects, which we'll be going through in the seminar, about who you would name as potential trustees to your will, beneficiaries, why, and having conversation. And we can get into those details as we go further in this webinar.
Great, thank you. Philip, and what kind of things do you talk about with your clients?
So yeah, no, I completely agree with Patricia. The other thing I'd say is that, the words or the phrase estate plan seems very intimidating. Oh, an estate. And really all an estate is our, accumulation over time of assets and liabilities in a nutshell. And so I think what we'd like to try and parlay today to everyone in the audience is it doesn't need to be intimidating, even though it can seem intimidating at first. Estate planning is not just for the wealthy or the uber wealthy out there. Estate planning is for everyone. I mean, to die without a will, let's just say, is not a good thing. You're really, in a nutshell, if you die without a will, you have put sort of your assets and the settlement of your assets into government hands. Big picture, okay? But by doing a will, whether it's a simple will or if your life is more complex and has a lot of structure, it's a more complex will and estate plan, you and your family and your executors or trustees get to control how your assets ultimately move to beneficiaries properly. And we'll get into this in terms of taxation, but obviously a big part of whatever is your estate is to try and minimize taxes on death.
Thank you. Okay, so getting a will organized is the first thing. So people would tend to go to a lawyer or a notary about that. When would you start to bring in a financial planner?
So, I'll start. I mean, you should bring in a financial planner, early. And whether it's your portfolio management firm, if they've got the capabilities, I mean, in-house at our firm, we've got the in-house capabilities to do full financial planning. Patricia does full financial planning, certainly at her family office level. It's kind of critical. I mean, if you go and run out to a lawyer right away, you can do it, but you know you're going to start paying fees as opposed to perhaps getting some advice from a planner or a portfolio manager to start getting your ducks in a row in terms of the things that ultimately you're going to need to talk about with a lawyer. So I do think that everyone, and again, it's not just for the wealthy or uber wealthy, should have a basic financial plan, right? Where they've got a very good sense of their assets and liabilities, of their cash flow needs. And that plan, by the way, is not a plan that you kind of throw into the night table drawer once you've done it and it collects dust. It's got to be a living document that you and your team of advisors pull out every year and make sure that all of your investing is properly calibrated to your needs, your goals, your end game. So I think that's really important.
And if I can add to that, whether you do it yourself, it depends how comfortable you are, or whether you have your accountant, whoever does your tax return, whoever who has an idea of what you own based on the tax slips that you provide them every year, is making a list of what your assets are. Only you know what you own and what you have and what you would like to give in your will to your beneficiaries. And it really is a matter of making that list, because people forget about certain things that have value and may have value to a particular beneficiary, but not to another. So by making just the list of all that you own, from your bank accounts to your brokerage accounts to your home, even pieces of jewelry that you would like to give to somebody, and just make a whole list of what that is. What's important at the time of death is to also know what was the cost of those assets. And not only knowing, okay, what did I pay, my home if I purchased it back in 1970 something, where would somebody be able to find that deed? So that if it had to be validated in case your estate gets audited and you're no longer around, where can your trustees or beneficiaries find the documents that can back up valuations? Because that's what's very important. At the time of death, it's the last time the government taxes you. So we have a death tax in Canada, not an estate tax. And the time of death is the last time the government can tax you. And they look at all your assets that you've owned at the time of death. What was the market value at that date minus the cost, what you paid for them, will determine what your capital gain is. And that's what they'll tax you on at that moment. So if you don't know what that cost basis is, and any additional costs, like in a home, you have major repairs, roof repairs, foundations, whatever major repairs that would have increased the value of your home over the years, those get added to your cost base. And it's important to keep those receipts. I know a lot of people usually don't, but it's the only way you can validate that the value, is higher because of those expenses, or even, just to get a spreadsheet and start, putting something down so that when you do pass on, this information is readily available to whoever's settling your estate, whether it's your trustees, your accountant. So it's a combination of having your financial advisors to work together as a team, because anything you have in your investment portfolio, also you need to know what the cost base is. And if you would have changed from one investment advisor to another, you have to make sure that as you're transferring over those assets, that the cost of your original purchase is on those statements and not at the date it was given to the next advisor. Those are very important things, because even if there's losses, you can offset those losses against the gains to also help reduce the taxes. So there's a lot of work to be done as a team, and maybe the lawyers and notaries are not the first people you go see, but really yourself make that list of assets, your accountants and financial advisors to then look at cost, and if it was a market value, if something happened to me today, what would my estate tax or my death tax liability be? And then see, okay, well, where will the money come from? Because remember, you're deemed to dispose of your assets. Once you've disposed your assets, if you need to come up with cash to pay your tax, you might really have to dispose of an asset, and then you get stuck with double taxation, the deemed sale and then the actual sale. Well, there's things that can be done to alleviate double taxation. So that's why without the proper planning, you might have your estate get caught in a double taxation where you want to avoid that at all costs.
Okay, so that was a lot of information. So we've got a will. We need to have a list of all the assets we have. So you listed real estate, our house, appreciated securities, perhaps other valuables, art, jewelry, things like that. You want to know what the original cost of those are. So what are the options for disposing of some of those assets in a tax-friendly way? Let's say you have a vacation property and you want to pass that on to your children. What could you do, Philip, to maybe ease the tax burden on that?
Right. So I just want to add one quick thing to what Patricia said before I get to sort of strategies to ease the burden, which is, you know, there's two types of capital, right? There's the real capital, which Patricia was just talking about, and knowing where it is and what it is and what your cost bases are. But again, as we said at the beginning of this webinar, the other one is emotional capital, right? You will have left a group of people, children, grandchildren, friends, executors or trustees, and this inventory list that Patricia was talking about in terms of the real capital, the dollars and cents, is obviously critical, but it's actually, you know, really critical on the emotional side too, because you know, the more organized you ultimately are on death, the easier it will be for all of your loved ones that you've left behind. You know, think of it as a big binder that sort of, you know, not only has that inventory of assets and liabilities and deeds to real estate, but lets people know if you have a safety deposit box, where it is, and, you know, list of who your banks are, a list of your key contacts, lawyers, accountants, financial planner, portfolio manager. All of that needs, you know, birth certificate, key documents, birth certificates, passports, credit cards, all of that. Think of as an inventory that over, you know, a good bottle of your favorite wine, you sit and spend a weekend and sort of put that together. It's really critical. In terms, Julia, of your question about, you know, strategies, I mean, there are a bunch of different strategies. It's probably too numerous to cover, but to hit some of the highlights, I'll start and Patricia can then take over. I mean, one of them, of course, is while you're living, to be giving some assets to people that ultimately you were going to give assets to on death. So gifts to your children or grandchildren while you're living obviously will take down the ultimate tax burden of those gifts. Now, importantly, because I've seen this, don't give it too quickly, right? Again, if you come back to the cornerstone of estate planning writ large, is doing some planning, some thoughtful planning around knowing what your assets and liabilities are, and importantly, what's the most important? Cash flow, right? Cash flow is ultimately so important, and I've seen situations where people have either done it or were thinking of doing it and not taking into account that which they need to live on for the rest of their lives, to, you know, which comes back to their own goals and objectives. That's critical. But certainly giving away to your family members gifts during your lifetime is one way to take down that tax burden. Patricia?
Yeah, there's yes, there's a lot of things we can do. So trusts is another way of, I guess, deferring. Anything that you transfer to your spouse is automatically deferred. So you pay the taxes on death when the second of the two spouses pass away. If you were to give it to your children, then sometimes setting up trusts may be worthwhile. But there are specific rules and regulations that relate to trusts that one needs to really look to see if it is worthwhile to do so, depending on what it is you're transferring in, and also looking at the age of the beneficiaries that will inherit from the trust at a later date, and that you do name a trustee that you can truly trust to understand what their role is. I'm a strong believer of conversation and communication, because without that, people don't understand what is involved when a trust gets set up, whether it's done through a will or whether it's done, which is called a testamentary trust, or while it's done when you're living considered an inter vivos trust. It's very specific. And because it was a Super Bowl this past weekend, I'll use a football analogy. When a coach only trains the quarterback to throw the ball exactly where the receiver will be, and the quarterback knows exactly how to do that, but he never trains the receiver to receive the ball when the day of the big game comes, what's going to happen is that quarterback will throw the ball exactly where the receiver is. The receiver, not having learned how to catch the ball, the day of the big game, that ball will drop. Well, that's the difference of having your wills and trusts and all your legalities set up, but without the conversation with the beneficiaries to understand what it means to receive these assets when somebody passes away. Well, when they actually receive it, chances are they will drop the ball. They won't know what to do with the assets they've inherited. So if you don't educate the different parties involved, and if you don't have conversations with your family members, I like to say that I'm a CEO, a Chief Emotional Officer, in line with what Philip says. In this area of estate and tax planning, it's all about the emotions, and conversations are difficult. But if you don't begin them early on with your family members, then it won't get any easier. And when you do a will, it's very difficult to think when you'll pass away, because we all think it'll be never, but it will come. But if you can break it down and look at it in 5-year time slots, it's easier to understand in the next 5 years. It's easier to plan the shorter term. So if you regularly look at your will and update your estate plan and look at it in 5-year increments, you know, from when you're single to when you're married to when you have children to when you're a grandparent to when you're, and you break down life's journey in different easier foreseeable futures, then it's easier to make your estate plan and to speak to your family members and friends and charities and whoever you're giving your assets to understand exactly what it means for you to give them what you plan to leave them at that time.
So it sounds like when Philip is having his bottle of wine there with his binder, you should have a few other people at the table while you share that bottle of wine and make sure everybody knows what your plans are ahead of time. Great, great advice. Thank you. Okay, we talked about some physical assets. What about digital assets like your social media or your email accounts? Is there any way you can protect those, or do they get involved in the estate plan? Patricia, do you want to try that?
Well, I've never till now dealt with digital assets, but we're seeing more and more of this coming up, especially with Bitcoin and Bitcoins, Litcoins, and all these digital currencies that are coming up. And like anything else, you know, it's part of your list of assets, and there's a password to your wallet. And if that is not given to anybody, then that money is lost. Also, you know, we talk about now cybersecurity being very important, protecting passwords, protections. So these are all things that are part of the future, which is now and our future of what we have to protect. If our beneficiaries are going to inherit something, we have to know how do you get it into their hands. So you have to find a way, whether it's through your safety deposit box, through something, a safe in your home, or some place where you put that list of your passwords, or if you're dealing with a password protect software that, you know, gives you that big long number, and you just need that first password, you know, who do you trust enough to know where you've left that? And that goes back to determining, you know, who will your trustees be in your will that you really do entrust that information to, that they won't do anything to harm you while you're living and harm your beneficiaries after you're gone. There has to be somebody that should know where that is.
Philip, have you worked at all with some digital assets in the estate?
No, listen, I fully agree. I mean, we all today have so many, or many of us have so many different digital assets. And again, we're coming into sort of the crypto assets that Patricia referred to. And now even, you know, central banks are talking about digital coins being part of fiat currencies in the future. So I think there will be a lot of development as we continue in sort of technology 2.0 in this era. And so you've got to be very you've got to be very cognizant of what you've signed up for and where. And again, make it part of that inventory and make sure those passwords are, that you may be protecting them now, but you've got to put them in a safe place where, again, your executor, trustees, next of kin can have access to properly shut them down.
Okay, thank you. So in the beginning, Anne was talking a little bit about legacy gifts. Can you, Philip, explain to us how you could potentially include a legacy gift to a charity, to McGill or somebody else in your estate planning, either before or as part of your will?
Sure. Well, listen, I think that most people know that there are tax advantages to making donations generally. And it's a combination, excuse me, of provincial and federal credits, essentially, that ultimately donating to a charitable institution like McGill University would drive down your taxes. And so that's a good thing. And you can do it while alive, which many people, you know, we're bombarded annually for share of wallet across many different charitable institutions. But, you know, again, charitable giving is a very personal, emotional issue for people. But you ought not to be afraid of it in order to do it, because it is very tax effective, both while you're living. And to your question, Julia, of course, even after, you know, making a legacy gift drives down your ultimate tax return and the taxes owed ultimately by an estate. And, you know, I'll just cover one little idea that, again, because I find that for a lot of people, charitable giving, philanthropic obligations can sometimes seem intimidating, and people think, well, it's expensive to put things in place. So there's something called the 60-second bequest that I think is worth just touching on. When people have registered accounts, we just talked about RRSPs or RIFs, you designate beneficiaries. So the obvious one, if you're married, is we typically, you know, my wife is the beneficiary of my registered accounts, I'm the beneficiary of her registered accounts. Okay. But what you can do very easily is you can get from your broker or whoever is managing your registered accounts what's called a multiple beneficiary form. So at no cost, you can add a beneficiary like McGill University, for example, and set out an actual bequest that comes out of your registered account at death. Because again, that registered account rolls over to your beneficiary tax-free. But if I were to say today, in addition to my wife, Sherry, I'd like to leave $25,000 or X% of my RRSP to McGill University, I just fill out a form. There's no advisors or tax or lawyers needed. And you send it back in, and now you've added a beneficiary and you've created a philanthropic obligation and a charitable donation that is part of your legacy. So it's no cost, easy to do. You can change it over time, and it ultimately will reduce the taxes of the estate.
Oh, that's interesting. Patricia, you can also donate stocks, right? If I have investments, I can donate in kind to those.
Yeah, so before I get into that, what I did also want to add to what Philip was saying is Canada, with those tax rates that he was talking about, the federal and the provincial tax rates, Quebec has the best charitable donation deduction of all the provinces in Canada, where for every, because there's two rates, the first 200, you'll get a lower deduction, anything above 200 is a higher deduction. So if you combine the two, for, let's say you put $1,000 donation to your favorite charity, so you send $1,000 check to McGill, it would cost you $506, so half of it. So when you make $1,000 donation, you are really not making a $1,000 donation, you're making a $506 donation because you get $494 deduction on your tax return. In Ontario, it's $638 cost per 1,000 donation you make. So Canada does have very good deductions for charitable giving. When it comes to the donating of shares. This is something that instead of, so go back to what I had mentioned earlier, at the time you pass away, you're deemed to dispose of your assets. So if you have a portfolio of investments, we'll use one share, or one company that you have shares of, let's say Saputo Inc. So you have shares of the company, and they've gone up, you've owned them for however many years, the value has gone up. Now you have a capital gain on it, you're deemed to dispose of it, you'd have to pay taxes. But if instead you donate those shares to your favorite charity, so you say, I bequeath these shares of Saputo Inc. to McGill University, then that capital gain, the fair market value of the shares at the time you passed away, will be donated to McGill, and you'll get a tax receipt. Now, we have to be very mindful of changes in the Income Tax Act in 2016. There's what we call the graduated rate estate. What does that mean? In Canada, we have graduated tax rates. The lower your income, the lower the tax, the higher your income, the higher the tax rate. I also mentioned earlier, if you have a trust established in your will, it's called a testamentary trust, whereas if you do a trust while you're living, it's an inter vivos trust. Why did I mention that? Because the tax rate of a testamentary trust is also graduated. And on an inter vivos trust, you're taxed at the highest rate. In 2016, the GRE, the graduated rate estate, had rules that if the trustee designates in your final return to have a graduated rate estate, then that donation of shares to your favorite charity will be exempt from tax. So the capital gain won't come in, and you can give that donation. Whereas if you don't make that election, then what happens is the estate is deemed to dispose, pays the tax on the capital gain, and the estate ends up making the donation. So when you pass away, there's your final, you as a person, as an individual, the deceased return, then you become the estate of the late whomever you are, and then it goes to the beneficiary. So there's different legal entities that get set up, and if you're not careful with that, you may not get the deduction or the exemption of that donation, and it might go into the estate, and then the estate gets the donation, and if it doesn't have enough income, it can't use it. Whereas in a graduated rate estate, there's so much more flexibility. I won't get into all the technicalities because it's very detailed and it could be complex. But I truly suggest that if anybody is named as an executor of an estate, to truly be careful and seek advice on making sure you make that election, because it does help you in terms of reducing the taxes in the return that you really want it reduced in.
Okay, just before I let Philip get in there, when you were talking about the tax rates and if you made $1,000 deduction, what the tax benefit was, you can also in Canada pool your tax deductions between two spouses, right? So if you both made $500, you could pool it into one return. Is that not correct?
Absolutely, and that's exactly what you want to do, because the first 200, like I mentioned, gets a lower deduction rate, whereas if you pool 200 plus, you get a higher deduction rate, and you would like to pool it in the spouse's return that has the higher income.
Higher
try
tax
to get it down to a lower tax bracket.
Right. And just we were using McGill as an example there, and I don't think we mentioned earlier that, if you are thinking of giving to McGill, there are a couple of ways you can do that, but you can also, Anne was talking about the legacy gifts and the goal for 200, but you're free to direct your gift to whatever program you think in McGill. So if you're partial like Philip is to the law faculty, he could direct his to the law faculty or other faculties or student aid. So you have a lot of control over what you think people can do with the funds, and whether it's small as a recent grad or a larger one, then we're always happy to help you make those decisions. Now, Philip, did you want to get in on any of that?
So two quick points. I guess the first one, just following up, Julia, on your last comment. I mean, the other thing that's interesting about legacy gifts or thinking about philanthropy during your lifetime, of course, is the conversation that you can have, right? The conversation of sitting down with charitable institutions, it could be university or other, that you're interested in, but intellectually and emotionally, you can have a conversation of, again, back to your point, Julie, about where's best to put the money, to put my donation. I'm interested in a particular program within the Faculty of Law, or maybe I was a software engineer and very interested in technology, and I want to make sure that McGill has state-of-the-art IT, for example. So those conversations, it allows you to get very involved to the extent that you want to. And then the only other thing I think we'd be remiss in, just before we leave this topic area of some of the big picture ideas for donations, is of course the use of life insurance. And I think that I'm not in the insurance business, but again, as a portfolio manager and as a financial planning firm, we will quarterback what needs to be done with third-party experts. And life insurance, as many of you probably know, the proceeds of life insurance are tax-free, number one. And number two, without getting into structures, there are ways that you can fund gifts, charitable gifts and philanthropy today through the structure of life insurance. So it's a unique asset that has benefits potentially during your lifetime and certainly after your lifetime to both fund philanthropy and again drive down ultimate tax bills left to your heirs.
If I can give an example on that, just so that people understand how that works. So if, let's say, for example, you're in good health and an insurance company says, okay, fine, we'll give you $100,000 death benefit, and you'll have to pay $2,600 a year over 10 years. Okay. So, and you say, okay, and I'm going to bequeath this life insurance policy to McGill University. So McGill University, every year that you pay $2,600 premium on that policy, McGill University will give you a tax receipt of $2,600. That gets deducted on your tax return immediately, year after year. So after 10 years, you paid $26,000, but because you've been allowed that deduction on your tax return, as I mentioned earlier, in Quebec, it's about 50%, in Ontario, it's about 68%, that you're allowed to deduct on your tax return. So really, when you passed away, McGill will receive $100,000, so the death benefit, and you, out of that $26,000, have been able to deduct about $12,000 or half of that a year. So it really costs you about $13,000 a year to give $100,000 donation. So the numbers truly do make sense. It is an amazing way of doing this while you're living, and it doesn't cost much. Obviously, the premium amount of $2,600 depends on whether you're in good health, your age, and all the other actuarial estimates that come in with the life insurance. But it is a very interesting way to give a legacy gift while you're living.
Great, thank you. I will remind you, I mean, we've used a lot of time here. If you have questions and you'd like to put them in the chat, we'd be happy to address them. We had a few come in by email. One did come in during the session. It's about an estate freeze and issuing preferred shares, and I think that's just a little bit beyond the scope of what we would safely be able to do in this time frame. At the end of the seminar, you're welcome to reach out to either of the panelists or your own financial advisor. So I do see that question has come in, but I think that probably doesn't have a wide sense of appeal to our audience here today. Ones that we have received ahead of time were related to, which we sort of touched on before, and then I think we got skipped off at about leaving that cottage or that vacation property to my kids, or how do I decide the principal residence between my house and my cottage, and what am I going to do with both of them when I pass? So Philip, can you talk a little bit to that?
Sure. So I think that there are rules that define what constitutes a principal residence, and there are factual rules, and you've got to be careful. Certainly, I can speak to Ontario about making sure you don't claim two principal residences, and of course, the tax rules have changed inside the filing of our annual tax returns. Forget what year Patricia had started, but now you need to report on your principal residence, and you certainly need to report on on housing sale transactions inside your tax return. I think that secondary, because your principal residence is tax-free, that secondary property can attract tax. Again, there are structures that probably go beyond this in terms of the use of a trust or the use of a corporation, where you may be able to avail yourself of lowering an ultimate tax burden because of course a company continues to exist after death, right? Because a company is its own legal person. So there are some strategies that you can do. Now, of course, the other thing that this gets into, and I don't know whether you were intending it by your question, is whether it's a property that's in Canada or outside. Snowbirds, Florida, Arizona, Europe, those have their own issues that we can speak to, perhaps big picture. But the U.S. has, as Patricia said earlier, estate taxes that you need to be cognizant of. Again, there are ways to structure potentially an asset to avoid that in the U.S. And I think it also depends on ultimate value, if my memory is correct, about the value that you have in U.S. assets. But the same thing would apply elsewhere around the world. You have to be cognizant, obviously, of the laws of the country that you choose to own assets in. And again, you need good tax and legal advice before you sort of venture to make those investments.
If I can add to that, so a lot of countries have treaties with Canada, and the treaties will determine whether your ties are more closely connected to Canada or not. And then for any property that's, for example, U.S. situs property, it's property that remains in the U.S. because it's a permanent establishment like a home would be, then those are sometimes not part of the treaty because they are taxed because they are property of the country that they're in. In doing an estate plan, when you do put assets in a corporation and the property is only used for the family and it's not being rented out, you have to be very careful of the shareholder benefit rules. If a shareholder is benefiting from the value of that property and you don't pay rent to your corporation, then you can get taxed on the value of what, if you had to rent it from a third party, of what that is, and you'd be adding that income in your tax return. So unless it's a rental property and you use it for the time of year where you like to go down south and you can say you're earning revenue from it, then it's a different story than if it's a personal asset in a corporation. So just be careful for that. The other thing I wanted to say when it comes to principal residence. So up until 1981, you were allowed to deem two properties to be like a spouse. Each spouse was allowed to have a different property as a principal residence. But after 1981, those rules changed, where you can only designate one principal resident per family unit. So it's usually spouses and your children who are living with you. You have to be careful though, because you can designate your principal residence to be your cottage if that's where the higher capital gain is, and you want to have that exempted from tax. But there is a schedule called the T2091, I think, that helps you break down the properties from when you've owned them, what the value's been, so that if you designate your cottage from this year to that year, because that's where the biggest gain was, wherever the cottage is, or your principal resident from this year to that year, because that's where the big gain is, you have to be careful because you don't want to be caught with then adding into income that capital gain as opposed to deferring it forever because you're not taxed on principal residence capital gains. It could become complicated.
Yeah, it comes back to your original points about keeping good records and knowing, because you have to. It's hard to value those real estate units when they're not being sold in between.
Exactly. And then the last thing I have to say is that when you do gift that home, whether it's in a trust, a corporation, or outright to beneficiaries, that is where you definitely need to have conversation as to what does that home mean to you and the family. And then it goes down to what I call the governance issues, the decision-making issues, where the family members have to agree on how the expenses of the home, who pays for those expenses, and who decides whether the roof should be changed versus the bedrooms being renovated or the kitchen having to be renovated. And if you don't have the beneficiaries all agreeing and seeing eye to eye, sometimes leaving a vacation property creates more issues than it does benefiting the family. But you know your family, and you know the issues that you're having now as they come and visit, or who gets to use the home during the holidays. Is it on a first come first serve basis, or is it free for all and you all end up and who sleeps on the floor and who sleeps in the master bedroom, and you figure it out as you go? Those conversations have to be had, because I hear that that's where a lot of families end up having their biggest issue after the fact if you don't have the conversation. So it's all about communication.
Right. So I'm cognizant of the time here. There doesn't seem to be any more questions in the chat. So I'm just going to ask, before I wrap up, I'll ask each of our panelists if they have any final thoughts, and then I'll come back and we'll wrap up today. So Philip, are there any other last little things you would like to impart to our audience today?
Yeah, so just picking up on what Patricia said about communication, you know, I think a lot of times when it comes to sort of overall estate planning and some of that intimidation, I think an important question to ask yourself is whether the definition of equitable when it comes to your heirs is the definition of equitable, does it mean equal? And I think that's a big question to think about when it comes to estate planning. And the way that different heirs and potentially children, grandchildren, etc., whether they're treated equally mathematically, or whether equitable means something else. So that's number one. And I guess my only other comment that I'd like to leave with people today, and it sort of picks up, Julia, a little bit on the estate freeze question, which I agree is beyond the scope of this. Other than big picture, estate freezes usually have to do with private corporations, often family businesses, and there are structures that help get a bump in your cost base to kind of close the difference between your cost basis and fair market value to minimize tax down the road for the heirs of your estate. That's the big picture concept. But I think a more interesting and relevant concept for a lot of people is the concept of the double will. And because a lot of people are often, they think about estate planning, they go, oh my God, I don't want to have to go through probate. Often they don't really know what probate means, but there is a probate fee on assets. And I think it's a very fair thing to try and structure your affairs to minimize your assets passing through probate at death. The concept of having two wills, what's called the double will, could be very useful in the right circumstances. You might need a certain level of assets, but again, you don't have to be uber wealthy in order for it to make sense. It can save tax, and essentially you have two wills. One is designated primary. You put the assets, like third party, banks often want, well, not often, they demand that probate of bank accounts. So you put that in your primary will, but you can load up your secondary will, which doesn't pass through probate, with most other assets. It could be private shares of companies, it could be investment portfolio assets, it could be art, jewelry, collectibles, and those can avoid probate and the resulting probate tax. So that's another structure that I think is important for people to ask their advisors about.
Right, thank you. Patricia, do you have any final words for our audience today?
Yes, I just have to say, for the Quebecers that are listening to this webinar, we don't have probate in Quebec. That does not apply to us, and it's very rare.
You're making me feel like I should move back home.
Yeah, so we don't have dual wills, and we don't have the issue of probate. So we're very fortunate that we're under the civil law and not the common law that has probate. So just to mention that. So I guess my last comments are more, when you make that list of assets and you decide what to give to whom, and then there's a universality of your assets that you give to your beneficiaries. That's where I would say be very careful, because if, let's say, you have a car, in there, and that's in the universality of your bequest to your beneficiaries, and now 3, 4, 5 people own the car. That's a very difficult asset to share. So certain assets, you want to be very specific as to what you will do with it. I mean, you can even put something as simple as, I'm leaving my car, and then whoever would like it, then amongst you decide how you'll own it. Or you say outright sell the car and take the proceeds of that sale and divide it up to whoever the beneficiaries are. The same thing with, I've seen wills where somebody thought to leave the bank account to one child and something else to another child, let's say an investment portfolio equal to what they usually leave in the bank account. Now, when you're settling an estate, there's a lot of expenses, especially, you start with the burial fees, you've got, settling of the accounting, financial statement, the tax returns, etc. Where are you going to get that money? Out of what pool are you going to get that money to pay those expenses? And if it's not specific, it gets very complicated, because then you see, okay, well, what's the value of one beneficiary of the investments at the time you passed away versus at the time that the parent thought, oh, it's equal to what's in the bank account, but today it's not equal. It's either higher or lower, because we know the volatility of the markets bring that price higher or lower. So that if you're not conscientious of that, you could really derail an estate settlement as to where's the money coming from. And then the other thing that is also important to note, and I just had it in my mind, it's about, oh yes, when Philip was talking about equal or fair, if in your will you say that you will give a percentage of your portfolio to your children when they attain age 25, 30, 35, whatever it is, keep in mind the volatility of the market. That portfolio, when you passed away, let's say it's worth 100,000, and your first child turned 25, they'll get a percentage of that, whatever you say in your will. Now, when your next child 2 years from now attains age 25, that portfolio of 100,000 minus what you paid the first child could be more or less. So whatever value that is, and you take a percentage, it might not be equal to the percentage that the first child received. There's inequalities there that you can't help because it's based on market. So unless something isn't cash, where you can actually say cash is 100,000, it's 100,000, no matter, unless you want to look at the inflation. But you have to understand that when children are not receiving, let's say, portfolio of investments until certain ages that you name in your will, then chances are they will not get the exact dollar value, or the investment itself might not be worth the same from when each child receives bequeath.
Yeah.
That's what you have to really be cognizant of.
Okay. So we've got about 2 minutes left. I'm just going to try to wrap up some of the key points here. February and March is a great time to start thinking about your legacy, because your tax receipts start coming in and people start thinking about their financial plans. So if you don't have a plan in place, this would be a time to, get those pieces of paper ready. We talked about the importance of making donations by the end of February. If you have RRSP room and you want to do that. Then we talked about the importance of having a will and a well-documented plan, listing all the assets, trying to figure out where all the paperwork is related to the cost of those assets. If you have passwords or anything you want to do, and then think about how you'd like to distribute those assets, whether to your beneficiaries, whether to charity, in your lifetime, or after your passing. So any of those things would be the kind of discussions to have with both your loved ones while you can, and with your financial planner or your lawyer. If you would like to include McGill in some of that giving, then the Alumni and Development Office would be happy to talk to you about legacy gifts, about small gifts, about directing it someplace, anywhere along those lines. Finally, I would like to thank Philip and Patricia for taking the time to talk to us today. Personally, I found their advice very useful. I don't have quite all my ducks in a row according to their plan, so I'll have to get on that. I think there was a little bit of something for everyone in the audience to take away, and I hope you got some benefit out of it. So thank you very much for attending today, and I wish you all a great rest of the day. Thank you.